Okay, hello everyone. Okay, my name is Keith Engel. In the tax community, I'm well known, but I'm not sure about this community. I was in the Treasury many, many years. I came to the South African Treasury in 2000. That's when I met Chris. We knew each other back then in the good old days when we were in the Bedrock building in church. I've been in Treasury for 13 years. I was involved in a lot of the tax legislation, so some of this is my fault. I was involved, and you can throw rocks if you want to. Did that for a long time. I worked in an accounting firm for a while where I was around all of Africa. I did a lot of tax policy from there, and now I'm with the South African Institute of Taxation. We are a professional body, and our membership consists of tax practitioners and people associated with tax. So people can be official members, or they can be affiliate members if they just want access to our services and all of that. But we're a professional body, and even though Davi's gone, we do a lot of education, we do a lot of training, we do a lot of webinars, we do a lot of information materials to keep our people up to date. So part of our community is the wealth tax community. So you'll see that there is quite a bit in this space. You'll see a few others in this space, as you know. There's a financial aspect to it, there's a fiduciary aspect to it, and there's a tax aspect to it. And when you're looking at tax and fiduciary, a lot of it's cross-border. Increasingly, what you're seeing is cross-border. So before I get to the official presentation, and we'll have to keep an eye on time. How much time do I have till when? 45 minutes? You have to keep an eye on me because I lose control. Is that when you're looking at the wealth space, and I've seen it from the side quite a bit, is that there's ebbs and flows. So you're seeing we're talking about immigration, okay? I mean, when I came here in 2000, immigration was the rage, okay? It was 6 years after 94. You can go anywhere. I was single at the time. I'd go to clubs. I want to meet girls. People want to talk about immigration. Not the thing I wanted to talk about. Should we leave? At that time, there was a real push for immigration. And then during the Trevor Manuel era, which we were part of, things calmed down a lot. And people were feeling very good in that period of time. In the 2000s, we were feeling very hopeful. A lot of South Africans say, why would you want to leave? People were coming back. We were feeling very good. 2008, things started to change. And in 2008, there was that Zuma shift. Okay, you can always blame him. That's safe. That's not a political problem these days. But when we had some things that happened at that time, the first money that started to move was over the exchange rate. So that time, if you remember the good old days of 6-to-1, remember? The super rich said there is no way this is going to last. And they went to all the top firms, quietly in the background, and they started moving money. And then, as you saw, our rand has been dropping. We went through a period from 2008 to 2013 where I think it was kind of neutral. The world was a bit of a mess. We had a lot of quantitative easing. There was a lot of hope for Africa. And I think we were kind of falsely buoyed by that, but there was the corruption going on in the background. So some movement was happening at that top end over the rand. And then once the Van Rooyen incident hit, then things fundamentally changed. And the culture has fundamentally changed. And what you're seeing is steps. So what you've seen is a lot of movement of wealth offshore, and then a lot of immigration, which we'll talk about today. But before I get to the immigration issue, when it comes to the movement of wealth offshore, a lot of it, and I just spoke to Davi now, what's driving it is political risk. I think that's really the issue. I think people are feeling very uncertain politically, and a lot of it is wanting to feel safe. The second is the worry about the currency, because we are getting poorer as that currency is going down. That's why Davi was very insistent, keep the interest rates up. Because if you don't keep the interest rates up, your currency is going to drop. So you've got to keep that going. And then the next step that's also been there is diversification. And if you look at our growth, the companies on the JSC are not growing. So if you're looking, there's growth elsewhere. So you're seeing a lot of movement offshore. Now, the reason why I'm mentioning this is that in the world of tax, believe it or not, if you are a South African citizen, you are subject to worldwide tax, okay? I was there when we put it in. You can partly blame me responsible for that. That is the trend. But in the old days, you could get away with taking the money offshore and the revenue service not seeing it. Increasingly, the revenue service is seeing it. okay? And I get reports back from practitioners. A lot of times a client will say, look, I'm doing something, but they don't know. And the practitioners say, good luck to you. Because when it comes to all the financial institutions abroad, through the various treaty networks and so forth, that money is linked and they can see quite a bit. And so you need to be careful about that and report it, because they're going to catch up to you, and a lot of times they already know. So what's happening is the money is offshore is subject to the same rates, and getting money offshore and save taxes is getting harder and harder. There are structures you can do to mitigate things, more on the estate duty side than the income tax side. So if you set an offshore trust up or an offshore foundation, that is not the land to tax-free. Even if you put it in a nice little island, it isn't going to be there because the money's going to be reallocated back to you. So once you're here, there are some things you can do. There are certain products you can do to mitigate and defer. But the options of getting away free legally are over. That is it. Illegally, well, if you want to do what you want to do, good luck, okay? And that's a different crowd, a different discussion, and we wouldn't do that here. And I frankly don't know enough about it, but maybe we need to meet some people and find something. But that's illegal. Don't do it. That's not what this crowd is about. It's legal. So there are some products, and be careful also that sometimes there's a little bit of structuring that's going on where you see a couple of firms trying to create products that are very beneficial tax-wise, but they're usually right on the edge of the law. And so you think you can get away with it, but you often find that once it gets to court, you can't. So in a lot of your planning, you need to, when you speak to a tax advisor about planning, when they tell you, they shouldn't just tell you this works or it doesn't work. They should tell you how close on the edge it is, how risky it is. Because even if it works today, the government will catch up and close it down later. So if you look at the Treasury right now, they're very in touch with the OECD. They take pride in working with the OECD. And the big flavor of the month internationally is stopping international tax avoidance. So like the recent case of Coronation, there was a pension ruling. These were clever rulings. They were done well by good firms, but they were playing it on the edge and they thought they would win, and they won for a while and then they lose. So when you look at structures, you want to see how safe there are. There are a lot of good products you can use to mitigate and defer, but getting wholesale exemptions, it's not going to be so. I would take your chances. That's what I'm saying on that front. Now, the reason why I'm mentioning all this in the background is stage one is the movement offshore. What we're seeing increasingly is a desire to immigrate, okay? This is coming across from different people. So you'll see a lot of young people. So when you're looking at the space, and the commissioner talked about immigration, it's not hurting us very much. And his argument was, when you look at the super wealthy, they're not immigrating that much. And he's right. There is some immigration of the super wealthy. We don't have that much, but there is some immigration. A lot of the super wealthy are Plan Bing it. And what Plan B is that they move a good chunk of their assets offshore and they get a second citizenship abroad. So you'll see another group of people about second citizenship or second permanent residency. Portugal program, which kind of closed down. Namibia's recently opened up. You'll see that there are different groups out there, and they will tell you. If you take a look on your YouTube, there's some guy called the Nomad Capitalist. I don't know if you've ever seen him. There's the Offshore Citizen. There's a whole bunch of little groups. What they're telling people is Plan B. Now, this is not just a South African thing. It's an international thing. Henley and Partners did a good little survey, and they said, look at the migration across the world. There's a lot of movements, but a lot of the super rich are Plan Bing it. That's what they're really doing. And you'll see different migration patterns all over. So, for example, if you look at China and Russia, there's a lot of immigration out of there going on and out of Eastern Europe. So the world of migration is quite big. But for the super rich, a lot of it is just moving money and they're happy to stay. But there is some movement. What you are seeing is job opportunities and other things where people are moving. So you might be happy, you've got a good job, you're feeling good about life, but your kids, and the kids go, I don't know about my prospects, and they go abroad. Now you're older, your family's abroad, then you go abroad. That's a concept. You'll also see people going abroad for jobs. They're looking for different opportunity. Dubai being a big one. I'll come back to that. So this is a technical discussion. It's going to be very light. I've given you some slides because my people like slides. They feel better if they get slides. So we'll give them, but I don't read slides. It's not fun. So, but to give you just a sense of what that world of immigration is about and what the paradigm is. So when you look here, there's a basic legal paradigm. You've got South African tax residents and you got foreign residents, okay? If you were a South African, sorry for you, South Africa puts its 45% rate. I have a feeling this is a 45% room. Maybe it's a 40% room, but it's a high rate. Wherever you earn your money, it's all in the net. That's it. It's all in, and whatever rules apply to South Africa still apply to you. There's certain things you can mitigate, like capital gains versus ordinary, but you can do that domestically anyway. However, the big thing is when you're earning money abroad, you got to worry about the foreign tax as well. So if there's a foreign tax, you pay that first, and then South Africa, you pay the residual. So let's say you're in a country with a 20% rate, and our rate is 45, you'll pay them the 20, and the other 25% you pay here. So that's the worldwide system we have. As I said, there are products that can mitigate. That's a different discussion, but the easy days of evasion are long gone. Now, a foreigner is different. The reason why a foreigner is only subject to South African tax on their South African activities. Okay, that's it. So there is a point in your migration, if you migrate, where you go from SA to foreign, where you go from worldwide to SA source. So that's in the background of the planning that happens, because you no longer have a connection, just to give you a concept on that one. Okay, and by the way, feel free to ask questions along the way. We can ask questions at the end, but if you want to raise your hand in the middle, that's fine. I like an interactive discussion, and if something's bothering you, it's on your mind, say it. It's not a problem. Okay, so the big thing here is when it comes to immigration is what is the definition of resident. And I don't want to be too legal about these things. So there's a lot of words on the page. You can keep it. You'll have all your documents. I'm not going to read stuff off. But the bottom line is there's a two-part test in this thing. There is an emotional test, an ordinarily resident test, and there's a physical days test, okay? The ordinarily residence test is this old thing, probably dates back to the initial Income Tax Act of 1914. And basically, an ordinarily resident is somebody who's emotionally connected to South Africa more than anything else. That's really what it is. So an ordinarily resident, there are different cases here I've thrown, but the main one here is you're going to return home from your wanderings. So if you go abroad and you say, I'm going to die in South Africa, or I'm going to retire in South Africa, you are ordinary resident. Your heart is still here. You have not left. You will go to the rugby game when you get older. You will salute the flag and you will sing the songs. That's what the ordinarily test is about. It's sort of a national anthem kind of test, and that's really what it becomes. And if you look around the world, these tests here are similar to other countries. We're not doing anything really weird. Okay, so these tests, you'll see them in other countries as well. The only one that's a little weird is the US. So to note about the US, if you are a US citizen and you have a US passport, like I do, I'm a dual citizen, okay? I became a South African citizen about 8 years ago. And do I throw away my US citizenship? Because it is a pain. I will tell you, I know you have issues around South Africa, but the U.S. citizenship is a royal pain. Go onto the YouTube. But as long as you are a U.S. citizen, the U.S. claims worldwide tax on you until you give it up, okay? The only other country in the world that does that is Eritrea, okay? So that's it. 2 countries, right? I'm not sure if anybody ever leaves Eritrea. I'm not sure if you're allowed to leave Eritrea. So it's sort of like a North Korea of Africa. But the U.S. does that. Now, the reason why I mention it is your citizenship, if you leave temporarily or whatever, you can keep your South African citizenship, and it doesn't affect your tax status very much. It may be a factor, but the fact that you're a South African citizen abroad does not mean you should be taxed as a South African tax resident. Most of the world does not look at citizenship as a mainstay to tax residency. All right. It may be a factor, but you'll see there's a million factors. So it's not critical. So ordinarily test is an emotional test. Do you plan to return home? Now, your typical people are people who are going to work abroad for a 5-year stint or for several years, or people who come back. But this one kind of catches you a little bit, and you have to keep an eye on it, because what you think is an ordinary resident, you might have left the country. And you said, I'm leaving and I'm angry because of ESCOM. We've gone to stage 6. Now we're back to stage 1 and 2. Now we're feeling a little better. But when you left at stage 6, I never planned to return. But then a couple years later, you find that nirvana isn't there. And maybe South Africa isn't such a bad place. And by the way, there are South Africans who do return. Okay? We don't hear about them as much. But especially from Australia, something about Australia, they go there and some regulation. I've been there, it was a nice country. I don't know, it looks like South Africa, but they just, the South African, the Kiwi vibe doesn't do it. I don't know, whatever it is, but there's a problem. I actually was thinking New Zealand, they're happier there. Okay, so there's the ordinarily resident test. Now I'm stuck again with the thing. Okay, sorry. Yeah. Okay, there's this one with the ordinarily residence test. This is a multi-factored approach. You can see all these things. Basically, where are you, if you leave the country, did you still keep the house here? Is the family still here? Do you have your hobbies here? All of these factors. And then residence, your citizenship is very, very small. So all these factors, if we're an ordinary resident, common law test, you can see the same thing in the UK, you can see it in Canada, you can see it in Australia. It's this multi-factor test that's there. So when you're doing something on this, you really have to keep a file of all your facts. Okay? So one thing that was mentioned was documentation. It isn't just the FIC and them. The SARS documentation is becoming a bigger thing. And so if you're looking at your practice, by the way, whatever your practice is, it's increasingly about documentation and compliance. And that's a real problem for people because they often don't keep their own papers. So you really need like a home administrator now to deal with all these government regulations as to where all your files are and all of that, because that's really what it's coming down to. But you do need to document what you're doing. The other test that goes on is a counting of the days test. Now, when you leave the country and you're not in the country, well, then you won't meet the days test. This is more for foreigners. So foreigners will come to the country and say, I'm not really planning to stay, and they've been there like 5 years, and the government goes, we don't want to hear your emotions. I think you're a resident now. That's what it's about. So there's this 915 days, which is really a 5-year test, the way it works. But the only danger is, let's say you go abroad, you don't plan to return, and then you come back for a little like a summer or a Christmas, and you're coming back in some of those days. What's going to happen is your old time and your short time in SA may bring you back temporarily into SA. So once you leave the country and you want to leave, you've got to be very careful to count days when you return, because otherwise you can make a mistake and you were there a little too long and the commissioner is going to come calling you. So that could be a bit of a problem, but that's the second test. But those are the two tests. And again, all countries have them. It's only the US that has this citizenship thing that's going on. Okay. So there are two parts to this world. One is, are you a South African resident? And then there's the other side. Now, the big thing is when people go abroad, I know there's a lot of discussion about going abroad for tax, and I think that's why the commissioner spoke. People do not leave this country for tax. They leave it for other reasons. There might be some benefit in select circumstances to go abroad for tax, but it's pretty rare, okay? So if you think you're going to go to the United States and have a wonderful time with the IRS, good luck to you, okay? And to give SARS its credits, if you ever fill out a U.S. income tax return, you might just want to come running home. Because an individual tax return in the U.S. is a horror show, okay? They don't have the e-filing system we have. We have a much better e-filing system. It's much easier, okay? If you go to the UK, high tax jurisdiction. So if you name all the countries where South Africans are going, Canada, Australia, New Zealand, These are high tax jurisdictions. You are not going there to save tax. You're going there for a job. Maybe you've got other issues. Maybe your children, who knows? But these are high tax jurisdictions. Now, there is differences. I will say that you will find, like in the United States, that your middle class is taxed a lot lower than your South African. So one thing to note is that the super rich has got the high rates. If you're in New York and California, your rates can go up to 50%, okay? But you'll find that your middle level, and this is one problem that's happening in South Africa, is because they do this Gini coefficient thing, and that's what Davi Root was talking about, if you're looking about a rich people, we're not that rich, okay? Maybe you guys are. Look at my house. It's a nice house, but I'm not living in Silver Lakes, and we're middle. So what's happening, one of the problems is because you're being classified as rich, we're at the 45% rate, where if you go to the UK and you go to these other countries, you will find that your rate is going to be more in the 30s. And that's the difference, okay? So there is a bit of tax benefit there, but it's not wonderful, and it's not worth migrating for. But the reason why I mention these other countries is you're going to be there. So let's say you're there to work for 5 years and you want to return home. You're going to be taxed there. So the way, if you're working in the UK, you work there, they tax you there. And you will probably be subject to a rate of the 30s. Maybe if you're super rich, it could be up to 40, okay? So you're going to be taxed there. And now what you're worried about is, okay, I'm now getting hit by both ends. That's the thing. So when you work abroad, you want South Africa to leave you alone. If you want to come back, you want to come back. So the problem is here I am, let's say I'm in the UK, and I'm subject to a 40% rate. So now I do that return, I deal with my tax preparer, okay, that sucked. And now you've done all your withholding, and now you go, what about South Africa? We have a 45% rate. What about that 5% differential? Now you're like an American, because you were going to ordinarily return. So now you have to worry, and you got two tax systems going on, and you got to file two sets of returns. And it isn't about the money. Trust me, I do two sets of returns. It is horrible. It is horrible to file two sets of return. So that once you are on the other side, the question is, who do you belong to? And the treaties come along and say you belong to one or another. And their test is slightly different. So you can be a resident of South Africa, and the UK will say, look, even though you plan not to stay here forever, you've been in the country for 360 days. As far as we're concerned, you're a resident. Now you're subject to worldwide tax in the UK and worldwide tax in South Africa. You're very unhappy. What do? We have a treaty. So the treaty says, which country are you closer to? So you look at the South African law, you look at the UK law, of course, running up nice preparatory freeze. That's always fun. You've done that. Now you say, well, I've got a treaty. Which one do I belong to? And what you will find is that the treaty will often push you over into the UK, even though you may plan to return to South Africa, or it may not. But you don't want to be taxed on a worldwide basis for both countries. So there's the treaties. There are a number of treaties. South Africa has a network of 70 countries at least. We have a lot of tax treaties. That went on in the 90s and the early 2000s. All the developed countries, we've got lots of treaties, and they all look the same. So that does take some of the pain off. Now, again, it also may take the pain off on the UK side. If you're a South African resident, at least the UK is just going to tax your salary and no more. Otherwise, you're going to have a problem. They're going to want your worldwide income. You don't want that. So again, there's a number of factors here. These have been around since the 1920s. But you look to see where the permanent home is, where your personal economic relations are, your habitual abode. Then you look to the nationality right at the bottom. And so there are these factors. And then if you can't figure it out, you go to competent authority. Competent authority means you have the UK HMRC and SARS together work together on your behalf. The answer is that provision doesn't exist. They're never going to work on your behalf. It costs you a fortune. Don't be involved in that. Just stay out of that one, okay? But there is these tests, and you start looking at a lot of things. The question is, where do you work? Where's your family? Where's your car license? All of these things you add up, and you need to know, did you keep your old car license? And so a case that's quite popular because he's one of our own is Mr. Oppenheimer, okay? Never thought he'd pop up here. But okay, Oppenheimer was in the UK for a long time, and this is a UK case. And they say, boy, you're here a long time. You know, we know that your family dates back to the UK, and I know you're a South African, but you're here a lot, and you make money here. We think you're a resident of us, not South Africa. And so he went to court. Of course, he had an army of lawyers backing him up. Very expensive. One thing, as I said, if you want to make money, be a litigator in law, because billable hours rack. Once you're in the war, people fund you, like the war in Ukraine and Russia. Every litigation is the same, okay? So I chose the wrong kind of law, advisory law. No, litigation law, billable hours works, okay? So anyway, they generated an army of billables on this thing. And bottom line is, where did he go? So they were in front of a UK court, and ultimately the UK decided he was one of South Africa's. Now, there's a whole multi-factor test here again, but a lot of the issues were that his heart was in South Africa. It's really what you read. His heart was still in South Africa. He was making political contributions to the parties there. He had more of his friends there. He had a lot of corporate boards there. And so he was just that little closer, that he was more of a genuine South African. And after this whole case, they go through everything ad nauseum, and they decide he's a South African, no worldwide tax in the UK, it's worldwide tax in South Africa. But these issues come into play, and again, the richer you are, the richer your clients are, the more likely they can be seen in court. Because remember, one of the things that when you have with revenue authorities is when they pick things up, they have a risk engine, okay? And that risk engine, when it comes to things like this, if you're super rich, there's a bigger risk engine on you. And, you know, they'll see something there. And this is an easy one for them to identify, whether you're in the country or out. So even if you're not a risk, they might just ask you for a verification audit. You know how pleasant that is. So one of the things, too, I say as a tax person, and I see it in the field, back in the 2000s, a lot of things were about avoidance. How can I get my rate to zero? If you're seeing now in your field, as in the tax field, a lot of things is about compliance. Really is. That's what we're talking about, gray listing, due diligences. We're talking about more documentation to prove that you're a legitimate person. And the bottom line is that legitimacy is you're guilty until proven innocent. Forgetting the gray listing. That's the way the due diligences work. So all this documentation becomes a big thing. So the reason why I'm mentioning this documentation point is I don't believe that if you immigrate, you can work it out on your own. Okay, now I'm not a tax advisor. You will never come to me for that. I'm from the professional body. I'm not looking for business. But when you get down to these things, you don't keep the files. You don't keep the documentation. You need somebody who's going to help you get all of your document in place because SARS or the HMRC will audit you. And they are going to send some sort of, we call it a verification audit. They're going to ask a very simple question. Why do you think you're not a resident of South Africa? Because you've been in UK 5 years and you didn't do anything. You just assumed you're not a resident, right? Then SARS sends the verification notice, and there you are, and you get this thing, and your heart sinks. Because as much as you love Key Sweater, you don't like it when he writes to you. And when he writes to you, you get a little scared. And the worst thing you can do is he's going to give you 30 days or so many days to respond, and you go, I have to get my documentation together. Once you do that, SARS goes, we don't trust you. Why didn't you have this all along? They believe that you've been building this perfectly built case because you're a good person and that's what you do. And so you have no documentation and you have to look back 5 years to figure out what you did. And so when I say you go to a tax preparer, you're going there not for him to file the return. You're going there for the tax pack, all of the documentation that when SARS comes knocking, you say, oh, sure, we have all the stuff. Here it is. I'm telling you, I've been living in the country. My wife moved over here, or my husband moved over here 2 years ago. I got 2 kids in school. I've got my license here now. You have to not document all this stuff down. And you have to do it contemporaneously, not later. And so that's why these factors are a problem because it takes so much work. You have to paper the file. And the best thing to do is have the facts on hand. And if you come back quickly with those facts, well, then Revenue Service goes, I guess there's nothing here. But if you're silent, they start probing. They go, I don't know about this one. So very important. So anyway, that's part one. So are you a resident of which country? Now, there are two sets of people. There are people who are South Africans who are working abroad. Now, this was a big issue. At one time, I got to make sure my time here. How much time do I have? I lose control. Think I'm all right? I think it's, is that when you work abroad and you're a South African tax resident, you are fully subject to worldwide tax. But in the old days, the service income, the employment income you earned abroad, they call it remuneration, so you get confused, but it's employment income. If you worked in the UK and you were employed by the UK and they paid you in the UK, then that income was exempt from South Africa completely. And so that was great. So you said, okay, well, I know I'm subject to South African tax, but all that wonderful salary I made in pounds is being left alone. But in 2017, somebody got a bug up there, whatever, and they said, no, that's a little too generous. Now, I wish that Kosi Lowe was here. I don't know if anybody remembers him. Some of you have got gray hair like me. The great Kosi Lowe from SARS would never have done that, but this group went ahead and did it. He was at SARS. He was quite high up. But the point was, now they put in a new rule. So in the old days, it was completely exempt, but only the service income. Now, the problem was back then, which was pre-2017, people went abroad and thought all of their income was exempt because then I'm abroad. Why? Because they said common sense, I'm abroad, what does it matter? So there was a lot of evasion, and there still is, that it was only the service income that was exempt, the salary income that was exempt. And so what they've changed it now in 2017, and they've said it's only up to 1.25 million rand, which is exempt. Now, that sounds like a fair amount of money, kind of middle class. If you convert it to dollars and pounds, it's not very exciting. I know you got a big salary there, Chris, because from what I heard from Davi, but I have a feeling, this is maybe about it for, I've worked in the government, trust me. I wasn't getting paid, he wasn't either. You can forget it. So, but the point is, so that this is a middle class amount. If you convert this in, middle class America is $55,000. Okay, so this is a middle class exemption here. It's not a rich one. So anybody above this is at 45%. So now, you go abroad. And the one that got people very worked up was Dubai. Okay, so I remember being in Parliament in Dubai. I was in the hearings and all of that. And the Dubai people, they go abroad because it's exempt, right? That's what they offer you. See, the salary is pretty good. Yes, the costs of living in Dubai are high, but that's that exempt tax salary. You're exempt. So you're going to take all that cash home. Well, now you're going to pay the revenue receiver instead. So if you are a South African resident living in Dubai, that savings above 1.25 million, it's back to the old 45% rate. So that has changed things. So you're seeing a lot of people saying, look, I'm abroad, I want to break residency. And the ordinary residence test may or may not help, but the treaty is important. So if I use the treaty, I can get myself out. And usually the treaty looks more to a year-by-year basis, not 100%. But if you are living, working, let's say you brought your kids over and you may or may not return to South Africa, then usually it breaks. And then you're now going to be a resident over there, at least for that year. It's a year-by-year determination, and it gets you out of it. But this becomes a big issue. Now, they actually borrowed this from the U.S., by the way. The U.S. has an exemption that says you work abroad, we'll exempt your service income, again, worldwide for everything else, but it's about $112,000. They give you an exemption there. I think they set this one back. They were setting it in line with the U.S. This one has not been adjusted for inflation, so it's falling behind a little bit now. So this becomes a big issue for people being abroad, that they've got to pay tax back home if they plan to return. And even if they don't necessarily are unsure to plan return, they can't look like that SARS thinks they may return. Because if SARS thinks they may return, they're going to be back in here unless they can have a treaty. So then again, there's a whole bunch of treaty things there. Now, you say, okay, great. I'm going to leave. So that way I can get out of this worldwide tax system. And I went to Dubai for a reason, because I want a tax-free salary there. Or I've gone to UK and I don't want to hear from SARS. Well, the one downside of leaving is a thing called exit charge, okay? So the exit charge says, well, if you're leaving, we're going to give you one goodbye presents, because we liked you so much, but you've grown a lot here in South Africa. So it's sort of like a one-stop thing. And the U.S. has this as well. This says, well, if you're going to leave, now you're gone, we're going to take all your gains before you go. All of those capital gains and all of your ordinary gains too. Now, typically, you'll just have capital gains. Ordinary gains, let's say you have a lot of turnover of houses, or you have a lot of turnover of shares, you might call it ordinary. Most individuals just have capital gain. And what they do is they trigger all the gains and losses, the losses too. So you net out the whole thing and say, exit charge, and I pay on my net gain. So getting that freedom comes with a price. And therefore, there is a charge on that. And you need to do a lot of calculations around that. And there, some things are better than others. Like, for instance, endowment funds, there's no CGT on them. So an endowment fund won't trigger a problem. A unit trust will. Pension funds, no, they're a different horror. So you don't have to worry about them too much. The other thing that's out of it is there's some exemptions, like if it's still in the South African tax net. So if you leave South Africa, but it's still in the South African tax net, there's no reason to charge an exit on that one because it hasn't been removed. The best example is your house or residential property or commercial property, because they're going to tax you here even though after you leave, because it's still here. So there is no charge on that. But usually gets swept up is shares. Your financial instruments are going to get swept up. If you have foreign real estate or foreign property, remember it was in worldwide, now you're going to source, it's going out of the net. So that gets triggered off. And so one of the issues is you might not want to, you've got to leave and you got to think, well, how does this exit charge go? And even if I'm willing to pay it, do I have the cash to pay it? So do I have to sell something? So a lot of times people just say, look, if I'm going to be taxed, I might as well just sell it anyway and go. But movable property like your home, you don't have to sell. But remember, if you're keeping a home in South Africa, you might still be viewed as a resident. So there's this calculations that you need to do, and it becomes quite complicated. But that exit charge is something to be mindful of on your investments. So then just to note, once you're out of the system, then you're only subject to source-based taxation. I've said that already. Just some other quick things in there, and I'll try to wrap this up. There isn't just that of tax. There's process issues. Thank you. I need to be reminded of these things, so it's good. Is the famous exchange control. Now, exchange control has liberalized a hell of a lot in South Africa for individuals. Companies, it's still much more of a thing. And they've kept to their word. I think the DG has been big on that. So now you can take out the 10 million. You can take, and 1 million per year. You don't go through the Reserve Bank anymore. You're now going through SARS and SARS alone, and they report back to the Reserve Bank. So it's a very different system. And again, unless you're super rich, I don't have 10 million Rand, so I'm not too worried about it. But, hopefully you've got clients who are, and then you get into the issue of exchange control. So the exchange control, I'm not sure why I'm having trouble with the button. The reason why I wanted to give you this is that the thing you're going to do when you leave is you need to get, if you want to immigrate, i.e. you want to get out of the tax net, what you need is this document, this confirmation of exit. And that confirmation of exit is important also for your exchange control and this compliance pins, because you're going to want to pull out money. When your residence changes, you want it to be official. And the reason why that's important is once this is official, you're not going to be questioned again. It's done. Otherwise, if you don't do it this way and you quietly leave and you just leave and say, okay, what are they going to know? I mean, he doesn't know what I'm doing. I mean, whatever. And then you try to claim that you're not a resident. When you're over there, you're going to have a problem. Now, you may say, well, I'm never going to come back to South Africa again, right? I'm never coming back here. I'm angry about stage 6, and I don't know about 2024, and I'm done. But you'd be surprised, people come back. And they do. They go, I got all my connections here. I got my friends here. I got all my opportunities here. It's not so easy to leave economically. And if you come back, you've got a problem. And sometimes, too, you're still on their system. You see, you want to get off their system. So even though you're abroad and they still think you're here, well, they're going to still audit you like you're here. So these are very important. And this takes support. You can do it yourself. I wouldn't do it myself. Trust me. This stuff, you just do someone else. And the point is that's a processing out. But exchange control, you can get $1 million out a year. You have the 10 million. But if you want to go above, it's just about proof. You can even get more if you need to take it out. And so all of those things have to be done. And then once you're gone, you need to keep it right. So whatever's left, you need to pull out because you may still have your house. You may still have your pension and all of that. Those things are there. So just to keep in mind, there's an exchange control circular that explains this. It's the authorized dealers. The way it works is SARS does it, refers to the authorized dealer, i.e. the banks. The banks then let it go. But they tend to be very risk averse. So if the banks don't see the right documentation, good luck to you. That's why what Chris said was our banking sector is pretty good. We do keep things quite tight here. We have a first world system. So remember that. Sometimes it isn't a SARS problem, it's a bank problem. If you play things funny and the banks don't trust you, you can't move your own cash. Another issue is your pensions. Big issue about that. You can take your money out of pension after 3 years, but that's assuming you're under 55 or 60. If you've retired, you can still get that money out before. So there are ways to get that money out earlier, but again, if you haven't done things properly, you won't be able to get your money out, and most of our money is in pension, at least if you're middle class. Just to close, there are other little things you have to be careful of, and I'm going to wrap it up, is 2 other things to note. A lot of your clients are business owners, or they have trusts. So they have the South African trust, and they have the South African company. They're going, okay, I'm planning to work in the UK now. I'm setting up a new HQ. I'm now over there. I'm in London. Fantastic. Great. They have dealt with all that exit charges. One of the problems that they have is that all your SA companies are taxed on a residence basis also. And the fact that it's incorporated in SA may mean nothing. It may mean that the owner of the business who's left, have changed the effective management of the company. If you've changed the effective management of the company, then that company has left too. And that company will also have an exit charge. It may leave the South African net and go to source taxation, but it itself may have a tax charge. And the bigger one to worry about is your trusts. What's the typical trust? It's dad, mom, and the compliant person. Okay, that's another issue to discuss. What goes on, the professionalization of trusts. But if you've got one of these informal trusts, you may trigger a big exit charge on your domestic trust. And people are not aware of that. And so something to keep in mind. Last one to keep in mind is, let's say you want to work abroad and you want to be one of those IT people that Davi was talking about. Then the danger is if you go abroad and you don't tell your company, you may have exited and you're happy, but you might be creating a tax problem for your employer because you're working there full time. And what they might say is, let's say you're working full time in the UK and you're a salesperson. The UK will say, not only are you a South African resident, but so are we have a right to tax your South African employer. So you got to keep if you are an employee, make sure you don't make a mess for your employer. And those are my notes. I'm 0 and beyond 0. You tell me what to do, or I'll walk off the stage and let Chris take command. Okay, thanks.
Then we can sit.
I'll take a minute.
We can be. Yeah.
Okay, we can do whatever.
No, you can stay.
I can stay, okay. Okay, well, let me take questions, that's fine. Does anyone have any questions on this? And feel free. Anything there? Okay, I can't see, so go. Say that again, I'm just trying to hear.
So 3 years.
Yeah.
Okay, you have to wait, and then you reach retirement. So retirement age, we're talking 55. And after retirement
Okay, yeah, I was thinking RA. That's what I was thinking. Okay, there's a 3-year rule that overrides everything. So the way it works in domestic pensions is, if you retire, you can take it out. So if you retire before you leave, do that, and you don't have to wait the 3 years. Similarly, if you're 55 and you have an RA, just take it out at 55, whatever the normal rules apply. But the 3-year rule is, if you don't qualify for anything else, then you can rely on the 3 years to get the money out after that. Now, the only difference, and I'm not as sure about, is when you leave, do you have to take it out as an annuity, the 1/3, 2/3, or you can take it out as a lump sum? That I'm not so sure about. I'd have to check on that one. Because that may be the issue. You want it out in lump sum. You're not going to want a South African retirement annuity once you've left. But that 3-year delay has become a big issue. But I'm not sure if you guys know on the answer in that one.
But you can tax it and you're going to be taxed on it.
Yeah, of course. You'll always be taxed. I agree. Yeah.
It's going to be within 3 years and it's going to be taxed.
But you'll be taxable as a lump sum, which is a little better.
No, that's...
Yeah, a little better. It's little. Okay, another
You
question.
had a question?
Question: South African citizen and national residing in Qatar, working there, assets still in South Africa, including investments. How is the tax treaty on that? Only travels to SA for less than 45 years a year.
Well, you're in the facts and circumstances, right? So if it's not so much your citizenship, it's what are your connections. So if you're in Qatar and you're working there, let's say you're working there, and like a lot of us, you don't have a lot. Even though you might want to return, but you're living there, you're renting there, you've got nothing back at home. Even though you're a citizenship or it won't matter. If all of your economics are there, let's say you're single and you're working there by yourself and you're earning money, and the only real connection is your nationality back in South Africa, the treaty will say you belong to Qatar, and that's the end of it.
But then primary resident property is in South Africa, and investments discretionary, both discretionary and retirement investments are still in South Africa.
Okay, let me just say this. There's primary residence for residents. So there are two things. There's primary residence as an individual. So as an individual, there are two tests. Do you plan to return? And the physical day test. Let's say you plan to return. South Africa will claim you to be a resident. I believe Qatar may have a treaty. If it has a treaty, it doesn't matter that you're ordinarily a resident. You're basically doing everything in Qatar for that year. And if you've got your home and your license and your car, but let's say you've left your home back in South Africa and you're still renting, then you may have a problem. The treaty may say, look, you still got your home in SA, you have family there, and then you start getting into a situation you may be stuck in South Africa. So again, you have to look at all of your circumstances, all of this lists on the interpretation notes. And that's why you have to sit down with somebody and go through the documentation, and it becomes a bit of an exhausting test. Wish I could give you a better answer, but it sounds a little sloppy. Anyway, you tell me. I'm not sure if I'm seeing the right hands up.
Anyone else?
There's some over there, I see.
The last one, yeah.
Okay.
Interesting question. In our country, Section 4Q says that although the husband's got 100 million rand around, the wife will inherit free of tax. There's no estate duty on that. But now the customer dies. She wants to immigrate. Now he sells all his properties and she's got like 60 million rand. Will GCT come into the equation now, or will the 4Q still apply?
Okay,
Does that pull the money out?
what is 4Q? Oh, the estate duty. Oh, okay, the estate duty. I'm sorry. The way it works is if they sell other assets, well, then there's going to be a CGT event. There's a second question, which I haven't gotten to. I was talking about income tax residency. There's another one, which I probably should have put in here, estate duty residency. Now, estate duty residency is only a single test called domicile, which is very similar to ordinary resident. So let's say this person is an ordinarily resident, they born and bred in South Africa, then they're subject to worldwide estate duty. The CGT may have been paid, but remember, estate duty is a second charge on top of CGT. And so it doesn't matter. You'll always be subject to capital gains and death estate duty That's another tax you can look forward to when you die, is that second tax. So, but if they are not, let's say they're a foreigner who just came here and they plan to return, then estate duty is only limited to South African source assets. So there's a very similar test there. There are some treaties that mitigate it, but there are not many estate duty treaties there. But one big thing to note, though, is on estate duty, it's another subject itself, is that if you're a South African and you've got assets abroad, you always have to worry about two estates. Because you've got, let's say you're South African, worldwide estate duty, but then if you've got property in the UK, UK is going to claim estate duty on your UK properties. Reverse, if you're a foreigner and you've got South African property, well, the foreigner is going to be subject to foreign estate duty, and then you're going to be hit by South African estate duty. So there's that dual function that goes on. And I hope that helps in just a general explanation of what's happening there. Okay?
Thank you. That's all the questions we will take.
Okay.
I thought I had anxiety before this one, but it's just starting to build up more and more.
Sorry about that. But people can help you. That's the short answer.
Yeah,
Get rid of that anxiety.
Get professionals to do that. Thank you, Steve.